Hey everybody, it's CryptoBirb, Adrian speaking. Welcome to today's Friday webinar. Straight from blazing hot Dubai, 41 Celsius degrees outside the window. Temperature is pretty high, if you will. Economy is slowing down. The stocks are keep melting. Cryptocurrencies keep melting as well. Funds getting beaten down to the ground, getting liquidated, getting insolvent. Exchanges going broke. This is the reality we are in as traders, as investors. We are going to talk about the challenges and how to potentially approach them in order to benefit from those movements. This is what we'll discover and get a proper deeper dive into throughout our show. Make sure you stay tuned. We are going there right in a second. Welcome. Hope everybody is doing okay. This is CryptoBirb Adrian. Again, Friday webinar. Every single week, I try to bring some good news to you guys, the most relevant news that you can benefit from within the market on the personal basis, on the financial basis. That's exactly what I'm trying to do as well today. And starting it off real quick with, I think one of the most relevant news is, well, following the CNBC headline, basically, we're looking at a crypto hedge fund, Three Arrows Capital 3AC plunges into liquidation as market crash takes toll, right? Like I said, lots of exchanges going broke, lots of funds literally disappearing and evaporating out of the market after the cascade of bad sell-offs of the black swans, if you will, implications coming after Terra and Luna crash collapse, which happened in May. This is just a feather. This is just harvesting feather deals here, right? This is the long-lasting implications. The market is going definitely into this capitulation state, and it's not only on the side of customers, of clients, of retail investors, traders, market participants, but it also happens to the institutional markets participants, right? And we're talking about the biggest funds collapsing. This is pretty wild. And actually, I want to give it a deeper dive, into how the markets are doing. Note that the moment that this is recorded, the market is not open just yet. However, we're going to have a look at a proxy for the pre-market price action of the futures in a second. But what we know from yesterday, well, just looking at these industrial markets, right? Hopefully, it's getting played well. We're looking at the local rejection of the $32,000 points, right, for the Dow Jones Industrials average. After having kind of like an outside bar, if you will, or a bearish engulfing pattern, we kind of like saw this local tiny spinning top, which was a little bit of indecision on an intraday basis, followed by a sell-off to the downside yesterday. Okay, this is the reality when we're in. The market closed down eventually at 37.75 at about 80.82% on the downside to the negative aspects. Well, if we even have at the German DAX composite, which is also a proxy to how the European side of the market actually manages, well, there's a lot of deterioration as well, right? While not definitely having broken through the March lows just yet, we're looking at the major deterioration and a slowdown, okay, and the price action trending downwards on a short-term basis since June started, and now that we are into July already, that DAX is basically tagging the 12,500, 12,600 support, getting, well, potentially into the danger zone, into very much indecision whether or not the market is going to continue downwards. If we take a look at some stock sectors, then consumer discretionary is cyclical. It's kind of like a little bit down. It's testing this local range of the price action, perhaps in a form of some kind of a descending triangle, if you will. It's not looking the strongest for sure. Consumer staples, which is more defensive rather than cyclical, also kind of like tends to perform with this local declining tendency as well, right? There's little breakthrough in this case. The short-term mean has been reclaimed, however, so far, right? Which tells you that on a short-term basis, consumer staples are getting somewhat of a strength, potential sign of weakness for the risk of assets. Energy has taken a toll, definitely, on the, deceleration to the energy prices, right? There's been a decent massive overthrow from 83 points up to 93 points almost, right? 92.5, quite an overthrow, right? Like an inverse V-shaped reversal, if you will. This is quite a dangerous, I should say, for the short-term implications for the prices, mainly because it typically brings a lot of sell-off. And this breakaway gap, this falling window, if you will, also kind of like showed a lot of underlying selling pressure, and the local rejection of the short-term moving average after bearish crossover to the downside, right? So this puts energy prices in a short-term deterioration, short-term declines, potentially easing or creating a little bit of environment in support or in favor of the risk on assets. Why is that, we could say and ask? Well, the reason is that the energy and the gas prices tend to act as a hidden tax, right? So tend to act as a hidden tax, which means that the more tax you get in the hidden or non-hidden form, the less spendable disposable income you have to deploy in the investment markets. This is the reason why the markets have been lacking liquidity and an overall, a fact that the markets have been going drier and drier each and every single day. The energy prices were partially responsible for that. And now that it's coming off, I would argue we may see a little bit more relaxation in some time near future. Financials also down. Healthcare as a defensive, slightly keeping upwards, which is again a little bit more indicative of the future sentiment, right? Where investors choose more defensive markets than not. Industrials as cyclicals are down. The economy is not yet accelerating anywhere to the upside. It's in fact decelerating and slowing down. So that's also why industrial stocks are taking a toll here and taking a stain. Same materials needed for the industry development. Technology, after seeing a little bit of local upward swing, towards 133 basis points, you're looking at the local rejection of the resistance area. And utilities are taking a stronger rally to the upside, following through the local resistances, making new highs towards the 50-day moving average resistance. Okay, 71 points. A breakout to the upside may actually add some more encouragement to the further upside price action development. I hope, guys, this so far makes sense. Perhaps some of you may notice, that I've started definitely paying much more attention to the stock market, and because the stock market is, if you think about it, the proxy to how the economy works, and this has become more relevant than ever now that the economy is falling closer and closer to the recession, right? Inverted yield curve, right? The interest rate spread between 10 years and Fed funds rate, or 10 2 years fund yields. Well, inverted yield curve is definitely not promising, right? A recession threats economy slowdown. There is a chance we might actually be witnessing right now this inflection point in the economic growth, right? And this slowdown is very apparent. This double-digit inflation requires interest rate hikes, which is exactly what's been performing. With this, notice that the inflation wouldn't come off, right? The inflation wouldn't go down. So the politicians or the governors, that the central bankers, are more likely to keep pressing on the rate hikes, perhaps hiking rates even more than they promised, right, just to keep down the inflation. So far, it's been little to no effect, and the economy keeps slowing down as a result. Then if we're looking at some local other markets, and then, well, the bond prices are seeing a little bit of an upside movement, which is, I wouldn't say surprising, but it's definitely something interesting to watch and observe. Right now at 138 points, the major support of the major resistance of a 50-day average. If this gets through, there is a technical chance, to kind of like unlock some higher potential regions, potentially towards even 150 basis points for the 30-year bond prices. However, which I'm going to discuss later for the show as well, you're looking at the 30-year yields, which are still strong, right? And local consolidation may not necessarily make it come off so easily. While having a look at the futures prices for the futures contracts for E-mini S&P 500, okay, you're looking at a potential bullish setup, right? I was talking about this bullish divergence on the momentum oscillator, on the MACD, moving average convergence divergence, that it is. Okay, while the price was actually approaching the 50-day moving average. So 50-day average is a medium-term proxy. Anything between 3 weeks and 3 months is considered medium-term, right? That's why I say 50-day average is a medium-term proxy. And the fact that the price action, as in the futures price of the contracts, is well below the 50-day average actually brings, first of all, the mean reversion tendencies, as in there are chances that eventually the mean reversion process would act and the prices would come back again to the fair average prices for the expectations. And at the same time, there's been a little bit of this volume spiking somewhere here and there, right? So some potential bullish setups. However, this bullish setup is nowhere near confirmed because it's mainly driven by the strength of dollar and by the strength of yields still, right? Whenever the dollar and the yields are strong, the market is going to run out of the capital and liquidity. Like I said, high costs of borrowings because of high rate hikes, and basically interest rates, makes it shortens your supply of the disposable income you can deploy basically in financial markets. So this also dries up the market out of the liquidity and make the market much more downwards oriented. And until you basically get to see the futures contracts, in a form of sort of like a backwardation on contango, reclaim the $4,000 region, which stands for the resistance for the 50-day average, then you're looking at a still underlying weakness, right? I want to see some bullishness with a threshold, with a trigger breaking outside the 50-day average, showing the outperformance versus its own weakness. Now, having a look at the relative rotation graph, which is some of my new favorite tools that I use. As explained in the most recent webinar last week, we're looking at a 5-week basis, okay, 5 elements to the tail of each and every single sector compared, right? So we are looking at those, aggregated summary here on the change side, right? The tail color and the tail length is what informs you about where in the chart the specific sector is. And first of all, sectors, energy stocks tend to follow and perform this phenomenon in the financial markets known as sector rotation, as in capital tends to oscillate and fluctuate and move out from a weakening market to the improving market. And that's why when you have a strong relative performance against S&P 500, which is there in the middle, 100 and 100 interception, right? Far on the right shows you strong relative strength performance, outperforming nominally and percentage-wise, and the vertical axis JDK RS momentum, relative strength momentum, or out of ROC rate of change to momentum, how fast the outperformance changes or improves or declines. And it happens more often than not that the market rotates, right, from leading to weakening to lagging through improving to leading again. And you see different market sectors taking lead against others. So here in the improving quadrant, you're looking at the communications XLC and the technology XLK, right? Again, those are cyclical markets. And this is what makes me think that there is some underlying change in the market and there is some rotation going on. Mainly because the previous leaders, as in strong energy prices, right, or even utilities, XLP, XLB. So overall, defensive markets, and plus energy on top, they have been switching the rotation, as in they are still outperform S&P 500. They are on the right, on the far right. So which means that RS ratio is higher, but there is this moving from leading to weakening quadrant. The momentum, the relative momentum ROC of our performance declines. Okay, what does that mean? It means, again, that we have this tendency where defensive stocks are turning down in terms of the outperforming. They're slowing down their outperformance, and the cyclicals are increasing their momentum. They're not outperforming. They're on the left from the S&P 500. They're underperforming S&P 500. However, it may change in the future. So like I said, there is this potential inflection point, not only in the way that economy performs, but also through the proxy of stock market. So overall, the weakening in the momentum side for the defensive markets, for energy prices, frees up the capital and adds potential significance to the cyclical markets, which tend to follow the market cycles. So cyclicals and technology moving actually into leading quadrant when they start outperforming the S&P 500 on still strong growing momentum. This could be indicative of further future acceleration of prices and a proper sector rotation. Here, just a little bit of a different look. Well, nominal, I should say, absolute returns for the 125 trading days over the since 2022 started, shows you that energy is still on top, right? The energy is still here at about 30% of return year to date, while the very most of the stocks are actually trending down, right? So if you bought any stock but the energy stocks early this year at the start of the year, you're basically still underwater, despite some local improvements. Like I said, have been going on. However, on the S&P 500, it's not necessarily the most promising version there. Utilities, are basically, again, reverting back to the mean towards like 0% return. So after declining a little bit underwater, they're coming back again to the zero, kind of like neutrality threshold. Staples and healthcare. So we can see this clump of defensive stocks are a little bit improving, right? Which aligns, of course, with not necessarily the momentum, as in the amount of change in time, but in terms of the nominal returns, right? So nominal or percentage returns are slightly improving. However, this is not strong, right? There is some local deterioration being neutralized right now as we speak. However, this is not sign of strength with the underlying potential sector rotation, just like I referred. Naturally, rate tightening, monetary tightening policy introduced by the Fed, by Chairman Jay Powell, ordered, is basically about rate hikes. The rate hiking cycle, tends to dry up the market out of its capital in order to fight down the inflation, while the Fed, the central bank, is selling off their bonds, right, to regulate the higher yields. Selling off bonds decreases the prices of bonds and at the same time pushes the yields higher. That's the very basic mechanism of steering the economy. This is like the steering wheel of the economy, in the economy seat, in the driver's seat. So this is the reason why I've been seeing, yields going up on, of course, naturally. And the yields are still more relevant, for this major breakthrough, as in historically speaking, 42-year long downwards trend has just been, some time ago, was broken to the upside. This is a very significant historical change, once in generation, I would argue, right, where the yields are actually breaking this long-term sustained downwards trend. Very strong, powerful signal. What does that mean? Well, some people argue that the yields may double from here just yet in the overall chaos, I should say, of the economic slowdown and the Fed trying to tackle down, combat inflation, which may make them act even tighter, in a more tighter manner, increasing the rate hikes, pushing the rate hikes even more, even further, increasing the yields even further as well. So there is a chance we may actually see some further upside acceleration after local deterioration, right? So local pullback, local throwback on the way up makes sense. However, again, until the inflation has come off substantially, the Fed is promising that they're not going to stop tightening the rates, tightening the money, increasing the rates. That might be the future for this, right? The fundamental trend is upwards for now. The rate hiking cycle ordered by the Fed, again, is what defines the fundamental driver for the trend here. Hope it makes sense to you guys so far. And please let me know in the comment section if you have any questions toward it, so that I can answer these throughout throughout the comments checkup, health check in the community side. I'm definitely going to answer these with my team. So feel free to drop your questions, leave some questions, hit the thumbs up if you're watching that on YouTube. If you're not, highly recommend you switch to our YouTube, hit a thumbs up, hit the notifications bells on, turn it on so that you stay notified whenever we drop the new updates. On top of that, guys, I definitely want to get you some tips for all the proxy of the macroeconomic aspects analysis and the stock market analysis, which is proxy to how far the economy can go. This takes us to considering cryptocurrency as the next aspect to the puzzle, right? So how does crypto get affected by it? Firstly, let's have a look at the bottom indicator, right? And the bottom indicator, real quick check, just shows you that the correlation coefficient between Bitcoin and S&P 500 on the 7-week basis is still trading high at about 85%, 84% to be specific, right? So this 84%, it remains virtually at the historical highs, right? This is historically high correlation. And historically high correlation occurs typically when the markets sink, when the markets drop, when the markets correct, they tend to drop fast altogether. This is what boosts the correlation coefficient go up. At the same time, this means that on average on a 7-week basis, Bitcoin is well mirroring and reflecting, I should say, what the stocks are doing, right? So stocks weakness in the stock market is going to transform and translate into weakness in the cryptocurrencies more likely than not. And there is, well, if you will, 85% of the chances for it. Somehow correlation coefficient may be considered somehow this probability proxy, right? Because it's based on the covariance and covariance of a stock against market, and at the same time the product of multiplication of standard deviations. So one way or another, we are looking at a very strong correlation, which basically means and translates to the weakness in Bitcoin as long as there is weakness in stocks. As long as, or if there is a strength in stocks, Bitcoin has higher chances it's translated in favor of its own, right? Having a look at 200-week average and a 50-week average, you can tell that the 50-week average has not come off substantially. Like, first thing is, this is logarithmic chart, of course, one would say, but then there's not significant change nominally even out of the peak 48,400, if you will, down to 43,000, right? The 50-week basis, almost a year-long data, is still trading relatively, sloping downwards very steadily, right? And it takes time until it starts discounting the past 50 weeks of deterioration. Right now, we're looking at price action trapped below 200-week average, which is historical occurrence. Rarely ever in Bitcoin history, we're looking at that 200-week average, I should say, not being retested or not being bought back quite often, right? Well, faster than not. Historically speaking, the 200-week average has been a major buying spot, purchasing area. And while having Bitcoin 75% of to the downside, basically, of the peak, the drawdown 75%, is still leaving some downside potential in terms of how low can we go, right? Historically speaking, again, this is what translates to empirical probability and the frequency of these occurrences. Bitcoin tends to revert back in the bear markets, bounce back after meeting the 80-90% decline. So 80-90% drawdown is a typical drawdown on average for Bitcoin's declines in a bear market, right? So as being 75% right now downwards of the peak, makes sense to have some cash ready to deploy in the lower regions if we get them. However, it's all guessing. Nobody knows the future. Nobody has the crystal ball to predict the future. And that's what makes me think we should just consider that as a potential risk and not certainty. I've definitely made my moves into purchasing already. However, it's not complete just yet. I will definitely wait for more 2 purchases coming after breaking through the thresholds I hope to see. Right? If we take the Bear Pro approach for the medium term or short term price action, even cutting the volatility indicator on the bottom, the one trading system that I personally use and apply in my own strategy is the Bear Pro current time frame trailer breakouts. So current time frame trailer is an indicator that adjusts. Okay, it shows you the trend breakout threshold, a critical level that needs to be broken to the upside in order to see bulls perform, to consider bulls have the upper hand in the market, right? So right now you're looking at 22,300 almost, and this is the main threshold for the bears to lose control and for the bulls to regain the control of the market. So I'm not going to deploy any shorter term movements or shorter term capital buy signals triggers unless I see a major breakthrough above 22,300s. If that happens, this triggers my short-term position deployment, and I would definitely proceed to buy with this, right? There's been definitely lots of steadiness and steady, market movement in terms of how it performs to the downside. Only a couple of small chops on the in between, but other than this, there is definitely dominant downwards tendency which has been going on in the market, and doesn't change until we see this breakout over 22,300. Remember that those trend following systems, especially trend following breakouts, tend to suffer in sideways, right? You get chopped a lot in sideways. And because of uncertainty, because it generates lots of fake signals. And this is what decreases the win rate, as in this system that I personally consent to a trade with has typically somewhere between 30 and 35% win rate, which means that 6-7% of the time, 6-7 times out of the 10, I'll be wrong about about the market, and I'll be basically losing money. But then the risk management control is exactly what I do in order to keep the losses short, to cut the losses short, and let the larger trend develop, which makes exactly what made me save so much money after getting those signals, to exit and to cash out short-term positions of 30,000, right ahead this major crash happens. So this is my signal system. This is my trigger. This is my position trading kind of like a approach that I install here for myself, because it works well for me. And despite I am wrong 70% of the time, I make enough money on holding on to larger trends that develop that it compensates for the losses, and it actually pays off so much more. This is very typical. And if we take it, guys, finally to how the Bitcoin actually just correlates, or I should say positions itself against other currencies, well, let's have a look. Right, there's quite a lot of I should say noise here, right? There's quite a lot of inconsistencies. And if we take the performance of the past 173 days, or even take it a little bit further, just to kick off with the 1st of January, you're looking at 180 days. And this 180 days with of a price action shows you that Bitcoin in the red is basically down about 60% of the levels that the year initiated started with. The best performance is TRX, which is pretty interesting, right? TRX being only 50% down, while the clumps of the total market cap coins, just like XRP, Ethereum, BCH, Litecoin, BNB, Link, XLM, and so on, they are basically down typically 50 to 70, 80% downwards ever since the year started. So it's not only, it's not only a specific coin that is down, its entire market that is down 70, 80%. And this is exactly what it's telling you, right? There are some outliers which tend to perform or underperform by less, right? As in have some smoother performance. But overall, you're looking at the major crypto flush out. 70, 80% downwards is what we are seeing ever since the year started. So over the previous 6 months, this is pretty spectacular. And well, guys, in all honesty, until I need to wrap it, there are so many questions that I would love to answer of yours, and I'm sure some of them will appear here. And finally, again, if you're watching that on YouTube, make sure to hit the subscribe button, smash the likes, hit the notification bell, so that you stay always up to date with our releases. And this also comes with your action to ask lots of questions in the Birb Nest, our premium exclusive community that we have and that we serve to our amazing people ever since 2017. And if you guys want to trade, well, I'm definitely not going to say effortlessly, because it takes a lot of effort to learn that. But if you want to avoid stress and losing money and expensive mistakes, saving you so much time and money, then definitely you should come and consider free membership, right? I'm giving you 7 days free, a 24/7, 365 service from my team, from myself, tons of premium educational materials you're not going to get anywhere else. Insane daily discussions going on with daily webinars, crypto, forex, stocks, communities, commodities. You've basically seen that all I talked to you about. And this goes well beyond that. Automated signals, automated systems, scanners, screeners, all that to save you so much time and money. If you guys want to be part of that, come up to thebirbnest.com, 7 days free trial. Sign up free, upper right corner here exactly. Click on the button, give us your email, first name, and we're going to set you up automatically within seconds via your mailbox. Going to get all the invitations, all the instructions, clear, sound, and beginner friendly. If you guys want to be part of that, be serious about your money. No goofing around, no no joking around, just be serious, money talk, then I welcome you there. I'll be waiting to answer all of your questions along with my team. That's all, folks, I've got for you today. Hope you're staying safe. Definitely trade safely. God bless you all, and I see you around. Bye-bye.